Have you noticed that everything is becoming an AI stock lately? It's becoming difficult for investors to figure out what's AI and what's not. Want to know one simple trick that helps you figure out what's really AI? Revenue growth. Plain and simple. We're in peak AI hype right now, which means revenue growth is a must. No teams with dreams. Double-digit revenue growth is the minimum acceptable entrance fee to the AI disruption club. And today's company has had solid growth ever since we started covering them 8 years ago. You want to know the ticker, don't you? Well, hold your horses there, Rooster Cogburn. We'll get to that in a second, but first let's start from the beginning. About 8 years ago, I was talking to the head of marketing over at Affinity. They're a company that uses AI to match customers to call center agents. It's all rather slick. They do it in milliseconds, and they're able to show proven results when it comes to creating efficiencies. In fact, their business model was simply to take a cut of the savings they realized their customers. Now, they envisioned a future where facial recognition would recognize you as soon as you enter the store and then immediately start to tabulate all your data, your income, your current assets, your lifestyles, your hobbies. Then they would even go so far as to match you with an appropriate salesperson who would be the best fit for the type of person that you are. Now, we thought about how this approach might be further extended to the digital world, and that's what led us to Zeta Global. And we covered them here, 7 years ago. And this example they provided, they said, well, we have a database of 350 million people. We could identify a cluster in that database of, let's say, 7 million people that would look like your best customer. Then we can reach out to them via messaging, social media, and look at who interacts with the messages, what they click, and then their machine learning platform would get smarter and fine-tuned to help even get better over time. This is back when people used to refer to artificial intelligence as machine learning. That's since changed. And I like this comment the CEO made when they had their April 2021 IPO. They said data plus AI equals intent, and the CEO said that a few people had asked him that day, who's AI and why is he in charge of the data methodology? So that was right before AI hype really hit. So just a couple slides from their IPO deck, which I think are useful. They talk about how their platform and data will empower many of the world's largest consumer brands to acquire, grow, and retain customers at a lower cost than they can without us. We were actually looking at how we might use their solution for our own business. And here you can see their proprietary data sets matched to marketing channels, and that's their ZMP platform. And here are some interesting metrics. You see the global Zeta-owned digital email IDs, 1.4 billion. That's a lot of individuals. Visits to real-world locations, so they're not just doing digital. They're combining all these different channels. Data elements per individual, I found this fascinating, 2,500. I can't imagine what those things might be. Actually, we will take a look later. There's a static data and dynamic data, so your behaviors online can certainly be tracked. We all know that. But aside from just email marketing, how big is this opportunity, the things that we're describing? Well, they say a $36 billion total addressable market. Would certainly have some questions around that, and they further elaborated in a recent investor deck here you can see, saying it's even larger than that, something they're calling intelligence-powered marketing. We know this stuff can get very complicated, so what it all comes down to is the ground truth for any company that's disrupting with AI, and that's revenue growth. And here we can see some rather impressive numbers. So annual revenues, look at that, at 20% revenue growth, at least over the past 5 years. This year they just raised guidance, they're expected to realize 35% revenue growth. So growing faster than even Palantir. Of course, they're smaller, so it's expected that they should be growing fast. However, not all growth is the same, and that's where you look at gross margins. We'll look at those in a second. I put up quarterly revenues here so you can make note of some cyclicality you see there. In the first quarter of every year, revenues seem to dip. And the CEO commented and said that even if you take out political, so they do some political work, we know that's one time, so you sort of need to subtract that from their growth. And they say we've grown the business 25% organically for the past 3 years, and that's something we disclose voluntarily. So this brings up this point of growth through acquisition, and what you don't want to see is a SoundHound situation where the core business is stagnating, so they need to acquire growth in order to show growth. And here you can see this slide talking about 4 of their guiding M&A principles, how they expect to fully integrate into their platform any acquired company in less than a year, be accretive from day one, so that it's helping to grow the acquired business at a faster pace than their overall organic growth rate. And of course, the often talked about synergies. Now, they've acquired a company every year on average for the past 7 years, and that pace has been criticized. And of course, in order to successfully acquire companies at that pace, you'll want to watch more than just top line growth, and that's where the free cash flow number comes into play. Pay very close attention to this, and I'm going to tell you why that is. So a business that's generating free cash flows doesn't have to sell shares to raise capital or take on debt. Now, when you look at their revenue guidance raise, this is recently a bump from $925 million for 2024 to $986, and they provide these steps. Very interesting slide here. I haven't seen this before from a company that raises their guidance and provides such detail. Their live intent acquisition being a piece of that. Political candidate, you can just back that out, right? That's not something that's expected to be sustained. And then the rest of Zeta. So relatively healthy business. When you look at their investor deck, though, it starts to get confusing in a hurry. Here you can see where they referred to scaled customers and total scaled versus super scaled, and they sort of describe that with the average revenue per user there for scaled and super scaled. So companies are spending a lot of money on this platform. GAAP cost of revenue, there's your COGS, so 60% gross margin. I mean, that's reasonable for a software business. It's the minimum that you ought to expect. When you look at their competition, I think that's important to note. They put up this slide here that shows how they're operating across data management, marketing, automation, and engagement, and some of the names that they're competing with, some fairly notable firms. They're well diversified across a wide range of verticals. I like this slide, shows how some of their verticals are being challenged, insurance and automotive. And then when you look at the clients they're serving in terms of marquee names, you see over 40% of the Fortune 100. That's very important for reasons we're going to talk about in a second. Now, shares halved, and that's after they increased quite a bit this year. They halved, and they're still up 100%. Why did shares fall? Well, there's 2 main reasons here. The first is that on November 12th, they had earnings miss and some growth concerns, I think, around those political revenues. These days, the market is quite demanding, and it doesn't matter if you show them 35% revenue growth. They want to see more. But what really hit the share price was a short report. You'll often see people talking about short attacks. Well, dismissing people who are critical of your sacred cow is probably the most amateur hour move we see people make out there. There's this idea among investors, especially newbies and young investors, that the world of investing is binary, or either short or long, where we're neither. And we simply provide commentary on firms that our paying subscribers ask us to cover, or firms that we think might be interesting for investors. Short sellers perform a legitimate function in the finance world, and you should be grateful for their criticism. So if you're long Zeta, or you're thinking about going long the firm, then you'll want to read this short report from Culper Research. It's titled Shams, Scams, and Spam. And what I quite liked was that Zeta not only came out with a response the day that the short report was published, which not a lot of companies will do, but they came out with an entire presentation 7 days after that response. It's titled Setting the Record Straight. What they've done here is aggregated all the points of contention raised by Culper Research, and I've put some up here. So they talk about Zeta misleading investors about its revenue by using round-trip transactions and two-way contracts, and the company responds to that. I think that you ought to watch positive operating cash flows very closely, because nobody has a magical money creation machine, well, except Michael Saylor. He's that gentleman that spends all his time doing interviews on YouTube and talking about dams and lakes and magical internet money analogies. So he's the only one that's been able to create a magical money creation machine. But for all other companies, they can only generate positive operating cash flows if they're selling something for more than it costs to produce and able to cover their cost of goods sold and their operating costs. So watch that closely. And they talk about the company quietly spinning up its own network of consent farms to wrongfully harvest data. There's numerous accusations surrounding this. It's possible that some of the acquired companies that Zeta had picked up were doing something hokey, and you never really figure that out until you acquire a firm and you get to find where all the bodies are buried. But certainly you can be assured that they're on it now. Their data cloud requires new data from sources with at-risk business models. Well, I think that one of the concerns you'd have with a business like this is privacy and all the legislation coming out of the EU. And this chart here from Zeta sort of addresses their ability to manage through data privacy regulations, browser updates, and still grow their data set. So as long as they're showing revenue growth over time and customers are spending more money over time, then certainly they're providing something of value when it comes to data. Again, this comment about predatory consent farms driving growth. They say Zeta engages in almost identical schemes as Fluent, a firm that had been in trouble when it comes to regulatory risks. And we would say here, if the SEC makes a move after the company is this open about the short report, and that's certainly a concern. And the list goes on. So there's more than 10 assertions that Zeta addressed in their 15-page deck, and I think it's rare to see a company this openly address a short report. And even the CEO had given an interview with this firm, Ad Exchanger, talked about, he'd said, all I can say is that we're an ethical company. We wouldn't be able to service 40% of the companies in the Fortune 100 if we were playing games. Agree with that. And you really want to pay attention to this next point. He says, I have to say we haven't lost one customer because of all of this. We've done calls with all of our 25 largest customers. They've been inquisitive. They want to talk about it. Of course, the people pay attention to this stuff. And he says, well, it quickly moves to empathy. And by the end of the call, you're hearing, God, we're sorry this is happening to you. You can take that, I suppose, with a grain of salt, but we just don't see companies that are that open. So what should investors do? Well, probably just hurry up and wait. So right now, this company has a simple valuation ratio of 4 versus our catalog average of 6. So that's simply market cap divided by annualized revenues. It appears to be quite cheap growth. Now, when something like this happens, everyone is on red alert. The customers are, investors, regulators, and especially auditors, because their asses are on the line. So what more risk-averse investors would do here is wait for the dust to settle a bit. Wait for their next regulatory filing and then look for additions. That's what we call in the business CYA, cover your ass, where the auditors will, they're certainly going to probe any accusations that might make them look bad or put them in trouble. They're not going to take on that risk themselves. So next investor deck, pay attention to whether any customer numbers drop. That's going back to what the CEO had said. And I think any SEC letters are going to be a clear escalation and would likely be troubling. So Zeta certainly appears to be quite an interesting way to play growth in the marketing automation space. They're leveraging AI and big data. There is some unknowns around this short report, but frankly, I think the company addressed them quite well. And for investors interested in getting exposure to this space, this is quite an interesting play at a reasonable valuation for the growth that you're getting. So when it comes to little known AI companies, there aren't many out there, but we did cover another one I think that's worth taking a look at, a little known AI SaaS IPO. Give that video a watch. Thanks so much for taking the time to watch this today.